And I'm opening up the room now as well.
Great.
Hey guys, just to give a quick sound check, everybody should be able to hear this right now. Let me know in chat if otherwise. Perfect, perfect. All right, guys, we'll be starting at 4:30, so about 1 more minute.
Hello, everyone. Welcome to the Art of TradeStation. I'm David Russell, VP of Market Intelligence here at TradeStation Group. Today, we're going to be talking about the versatile covered call, which can be bullish, bearish, or neutral. Before we get started, I wanted to just read some disclosures. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. This presentation is not an offer or solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone. Options and futures trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information handout or the electronic disclosure information available on the TradeStation website. Well, we are talking about options today, but I did want to just mention that we are actually right now doing a special 50% off futures brokerage fees. We have some details here in the slides that I'm providing you, but I want to just let you know there's a great there's an offer right now being made in the months of February, March, and April. So if you want to check that out, go ahead and open up the slides that we're going to be sharing. The actual slides we just put into the chat. If you have any questions, please put everything in the chat. Don't use the like the QA or the hand raising or anything like that for this webinar, please. And if you open up that zip file that was just shared, you're going to see this. This has two things in it. First, it has the Art of TradeStation, covered calls. This is just the slides that I'm going to be going through. And secondly, it has an ELD file, which is about a month ago, I did an article about some indicators on the S&P 500 with a special indicator with the 200-day moving average. And this is a special study I promised at the time that I was going to share with customers. And if we have time, I'll show you how to use it. But if not, there is an article and there's a link to it at the end of the slides as well. So very good. Now, before we get started, I want to very quickly just mention some of the things I do here at TradeStation, because I do the Market Insights blog, and I also do some ideas over on TradingView, which is a partner of ours that has an API connection with a brokerage account. So first, if you're on the TradeStation website and you click on Insights, takes you to the Market Insights page, which I mostly run this blog. And then also there's a link actually to this article here. If you look at this one about the NASDAQ, it links through to an idea that we published over on TradingView, which you guys can see here. I'm going to share this link. These are just some kind of chart analyses and things I do. And I want to just mention because we had kind of done different chart analysis at different points in time. For example, we had talked about a potential, bounce coming in the S&P 500 after this big sell-off here, but then also previously we had mentioned the fact that the S&P, had a false breakout. So we had back in, first part of January, we were pointing out to the potential of a pullback here, and we got it. We were talking about the potential here of a bounce, and we got it. And the most recent one that we did was just kind of looking at the continuation here, what's been happening with the NASDAQ, and the fact that it went back up to this level, which was a 50% retracement of the drop. And I think when you look at it right now, just a takeaway I would have off the top of my head is that we have a little bit of a toxic mix here. You don't want to be too bearish when you look at the overall market, because there is right now a lot of demand still for stocks when you look at it. There's a lot of cash on the sidelines. There's a lot of bearishness when you look at the sentiment. A lot of the different sentiment indicators have gone very bearish, which can be a contrary indicator. But then the other thing is that there's just, a lot of people who are, wages and everything doing well, people saving for retirement. There's a lot of demand for equities. But then when you look at the situation in the market, in some ways it's a little bit, some real negatives when you consider the fact the Fed raising rates, but then also some of these companies that have shown real weakness in the secular growth, things like Netflix and PayPal. But then you look at what Amazon just did, they're raising prices for Amazon Prime. So there's all sorts of things going on now. And so from my perspective, when you do the S&P, we've had this long, rally for like 2 years. And, this could just now be a period of consolidation. Everyone wants to be bearish. Everyone wants to buy the dip. And maybe now what we get is we just get chopping up, chopping down for a few months as we kind of let the Fed do their work for a while, see what happens. Valuations, come back, closer to historical norms. And so that's kind of just the kind of perspective I have here. And in some ways, this is a pretty interesting environment when you think about things like covered calls. So as we now look at covered calls, we're going to go through and really appreciate covered calls from the perspective of net delta. That's really like the basic principle that I'm going to be using for this. Ways that covered calls can be bullish, neutral, and bearish based on net delta. All right, so now we're going on to slide 5. Covered calls pair a lot, and I hear pair up a lot of 100 shares with short call contracts. 100 shares of stock match up against one call. You are selling some of the future potential upside of your stock in return for premium now. The view can be bullish, neutral, and bearish, and the net delta is the main lever traders adjust to achieve this bullish, bearish, or neutral view. So what is delta? Just to be clear, delta is the dollar amount that an option moves if the underlying stock moves $1. All calls have a positive delta, which means if the stock goes up $1, well, if you have a 50 delta call and the stock goes up $1, the call will go up by 50 cents. So basically, when you sell calls in a covered call strategy, you're adding net delta, because if you own calls, then basically you have a positive delta, and if you sell calls, you have a negative delta. You basically take the delta of the call, multiply it by -1, and that's the delta of the short call position, but you own 100 shares as well. So you have 100 shares, and then you have the negative delta from the calls, and that results in the net delta of the position as we see here. So for example, if you have calls with 50 delta, you would have 100 delta, take away 50 delta, the net delta is 50. So it means a covered call will behave like you only own 50 shares of stock. So the other principle, going on to slide 8 now, is theta. Theta is the amount of value or premium an option loses each day based on time decay. Theta increases as expiration approaches. So options with less time have, as they get closer to expiration, the theta increases. So a lot of the strategies we're going to use take advantage of the fact that theta increases as that happens. Higher delta calls usually have less theta in absolute terms. Theta is expressed as a negative number, so we say in absolute terms, and I'm going to show us in a second. And covered calls can profit from theta because you're short the calls. So let's actually go now and take a look. If we're on the TradeStation platform, I already have my Option Station Pro open. And I have some hypothetical positions. None of this is real money. I just opened up some hypothetical positions in some big companies. So for example, if you want to see, you go to apps and Option Station Pro, it looks like this kind of airplane or something here, like you make with paper. All right. So as we look here at some of these, some of the actual, wait a second, sorry about that. Some of the Greeks here. So for example, I'm now looking at some Netflix calls. And these are ones I brought up that expire on the 18th of February, which is the end of next week or 2 weeks out. And these are, weekly ones. Actually, no, I'm sorry, these are the standard monthly. But the thing we want to look at here is I have these Greeks set up, and we have, wait a second. Here we have theta. All right. So now the stock right now around like 415. What you'll notice is that the theta, as when you want to look, closer to the money, what you'll see is that when you look closer in time, you're going to see that there's a lot more theta at the ones that when you look at the actual premium. So if you look at the options here that are closer to the money, you're going to see that these have a theta of around 2 to 3. And now when you consider as a percentage of the actual value of the options, that's a much higher number than some of these that are deeper in the money. So the key point here is that when you sell ones that are closer to the money and a little bit out of the money, you have more opportunity to profit from theta. Even though technically these have more theta in overall like dollar terms, you'll notice that the premiums are so much higher. So the actual premium a person would collect and as a percentage of the actual cost of the position is a lot lower as an overall percentage. All right, so let's consider the idea of a bullish covered call. A bullish covered call would behave more like owning the stock outright, and it would have a higher net delta overall of the position. So you would target something of owning a stock, and then you would have short calls with a lower delta, which means they're going to be farther from the money. The strike price may be at or slightly above a price target or resistance level, depending on the charts. And this is going to give the stock room to run. So I've opened up some positions here. Let me just kind of show you how Option Station Pro works. Your columns might look different than mine, and you can adjust that by going up here to this little configure and go to customize columns, and you can control which Greeks you see. Now, the ones that I'm showing are theta, delta, and the extrinsic and the intrinsic value. So for example, when we look over here at something like the Februaries, what we're going to see is that a lot of these have very little, these have no intrinsic value because they're out of the money. And you can see that the most extrinsic value is here, slightly in the, right around at the money. Now, when we say extrinsic value, that means the value of the stock of the option that is in addition to, from the strike price. So if you have something like the stock is at 415 and you have 400 calls, that would have intrinsic value of, about $15. At this point, see what it's doing is it's actually taking the midpoint, but the bid and the ask. But the thing is that the extrinsic value is the time value that you're going to get from those options. And I'm actually looking at this is interesting. I have a feeling that I think the stock actually has moved in after hours, which is putting things in a different light because some of these numbers don't exactly match. And the options values are based on the closing trade. And then with this big Amazon rally, it's throwing some of the things off. So I don't want to confuse you too much of that. The key thing is you can show the extrinsic value. And what you're going to actually notice is that when they're out of the money, there's no intrinsic value. And then this kind of shows you what the extrinsic value is. And then you can also see here how this relates to delta and theta. So say we have a stock now that we want to be bullish on. Like say, for example, and I'm just choosing these based on with the movement we've had in the NASDAQ and things, a lot of these now you have to figure out what would be a stock that might be bullish. So say, for example, we want to look at a stock like AMD. It had a good earnings report, had this interesting rebound. So now we can consider what would be a potential way based on the principle I outlined. You want to look for calls that are more out of the money. and possibly near resistance level. So let's say we wanted to target, for example, around 140 on AMD. So we can go over now. An advanced micro, and we would look for something around like 140. Now, if you want to see more strikes, you can adjust it here. Now, the principle I have here would be to look for about delta of about 20, because that's going to be, if you have 100 shares and you sell calls with 20 delta, that's going to give you roughly net delta of about 80. So in this case, you would look to potentially sell something like the 135s, and by doing that, you would bring in $1.57 of premium, which would then result in a potential exit price of about 136.5, and that would target a move toward roughly here on the chart. So what does this actually look like? What I've done here is I've created some simulated positions, which you can see here. I have 100 shares hypothetically of AMD. So over here, if I own stock and I click on manage, it's going to show my positions. So now I'm going to go back over here to options, which is going to show the options of the stock up here that I've selected. And if I was to look, for example, at these, I can click on this and I can go to analyze sell, and I just go to single. Now, one thing is you want to make sure here that you're set the number of contracts, which I have in this case set to 1. And what this is going to do, this is going to show me now that I have essentially 100 shares, and then I'm short 20 deltas, and that's going to show me my net delta of my position. You can see right there. Now, if I click on this as well, on the equity, it's going to actually show me where the maximum profit is, which is right around this level that I had mentioned. And so the key thing about this is going to be a position that's going to give you room for the stock to run. And at the same time, what it's going to do is it's going to cushion against any near-term downside. Now, the interesting thing about a position like this is that if the stock jumps to say 135, those calls expire worthless. Now, when you look at this strategy, one of the things that make it interesting is when we go back here and we look at something like the 135s, we see is that these calls are going to lose 15 cents a day. As the stock, as we move closer to expiration, the delta is actually going to decline as well. So if we look, for example, now remember, these expire in 14 days. If we look at the options that expire, like, for example, on Friday the 11th, what we can actually see, if we look at that same level at 135, we're going to see that their delta is only 12. And as we get closer and closer to the money, closer and closer to expiration, those calls are going to track the stock less and less. And then essentially what's going to happen is our position will right now off the bat have a net delta of 80. But as we move closer, the net delta will increase. So right now it's like, okay, now I'm only own 80 shares, but then as time goes on, it's going to behave more and more like 100 shares. The idea of a strategy like this is that it can give you the potential for some extra value above the actual target price, while at the same time, if the stock just kind of drifts, you collect all that premium. And if the stock drops a little, then you're still going to be protected because you brought in about $1.57. So this is an example of a way that a covered call can be structured in a bullish way. The key thing is that you want to target a net delta. The way to think about it is to target the net delta of around 80. And by doing that, you're giving the stock room to run. And at the same time, you are getting a little bit of downside, kind of protection. The thing to think about with this is that if you're bullish, this sort of strategy makes sense. If you're bearish on a stock or you're neutral, then you want to be looking potentially for a tighter sort of strike and a delta closer to 50. That's what we're going to look at next. Neutral deltas, covered calls, behave less like owning the stock outright. You want to shoot for a medium net delta to the position, and that means you want to have a short call with a higher delta. These are typically at the money. It captures the maximum time value, but it also means you have no room for the stock to run. So there's a few ways to look at this here. In this case, you look at a stock like AMD, and this is one that, from my perspective, is like kind of tricky for neutral trade. Had that interesting earnings report, pull back now, and most some people might kind of view this as one that has some potential for continuation to the upside. Let's look at something like Meta. Now, I mean, Meta had this kind of big sell-off. And if you look at a model of something like Netflix, when a company drops this much, the question is, does it just keep going down? Does it stabilize? Very often what you simply have is a period of chopping, a period of consolidation. You get something of a bounce, but then it just retests and it moves sideways and it chops around. So let's say if we take something like Netflix as an example, and we think, Facebook now had a similar drop to Netflix, just earnings report that everyone thought was terrible, and stock gets hammered, but it's maybe now is the time you think this is something that has more of a neutral potential to sit and stabilize. So how can someone look to play on that? So the idea with something like this, potentially, we look over here, we're going to change the ticker to FB. A person at this point with the stock sitting around 240. Let me just see. Sorry, this is crazy because with the Amazon move, I mean, I think NASDAQ probably went up about 1%, 1.1% after hours. So I actually want to mention, I apologize, some of these prices are off now. Like Facebook is like $1 higher than where it was. When the market closed, it was at 137. We can see that here. And now it was at 237, I'm sorry, and now it's at 240. So it's basically gone up more than 1% after hours. So some of these options are actually a little bit off, but let's just say it's at 237 based on where the closing price was, because that's where the options are going to be. If we look right at the money, 237, voila, we have delta of about 50 delta. So if we go now and we simulate, I'm going to go to analyze sell. Now, when you go to analyze sell, what that allows you to do is that allows you to basically put it into your portfolio and then track it. But then at the same time, the nice thing also is you can do it after hours. You cannot, like, even with a simulated account, you can't buy up, calls or sell calls after hours because that market is closed. So what you now have is I had a position in Meta. I had 100 shares hypothetically. So if I now go back to my analysis, I can see here that I have 100 shares with a delta of 100, and now I've lowered that delta to like 48. And essentially now when we look at this position, what we have is we're going to have our theta of 37, which means every day that if the stock just moves sideways, you're going to just have 37 cents of value coming off those calls. And as time goes on, that 37 cents is going to increase. And so let me just go back to the chain and you can see what I'm talking about. So it's interesting when you look here where you have that right at the money, you're going to notice that that is where your maximum kind of theta is. What's also interesting, now we're looking at the extrinsic value column. You can also see that's the highest value. So when you have that neutral position, you're looking to profit from time decay the most. Now, the problem is if you're bullish this stock, like say we're hypothetically bullish AMD, and you were to look at selling AMD calls near the money, and it's at like 122 or something, what you're going to basically have here is like the 123s or something, is that you basically at this point by you're going to cut your delta down so much, and essentially if the stock goes up a lot, you're not going to profit from that. And then the other problem is that as that happens, the delta is going to increase on the calls that you're short, and you'll simply have your position flatten out to nothing as time goes on. When you're bullish, you don't want your position to flatten out to nothing in terms of delta, but when you have a neutral position, you basically want it to be flattening out to nothing. If Facebook was to end on expiration right around kind of 237, you'd basically have these calls would be at zero, and the roughly $11 of credit that you collected would be in your pocket, and you would basically make $11 of basically from time decay. The stock chops up, chops down, whatever. There would be times when the calls would be worth a little more, a little less, But if you're essentially neutral, this is going to put you in that spot where you're maximizing the time value you're getting. And you can see that with the extrinsic value column. Okay. I'm going to go to your questions in a second. I have to admit, this is one thing I didn't expect. The move in Amazon has pushed some of these prices around. So I'm going to go ahead now and proceed. Actually, before we do, I wanted to show you, hypothetically, another interesting thing here that we can look at. Say, for example, we had done this strategy on Netflix. Go back here and look at Netflix. So Netflix tanks on the 21st. So say a person said, you know, I think it's just going to go sideways. They could have done something at that time. It was right around $400. So they could have done something like sell the $400 calls. The great thing about TradeStation is we can actually see how a position like that would perform. And the way is, if you right click on this, you can copy symbol. And this is actually going to copy the option symbol. So now we can actually chart the value of the option, which I'm going to paste. And you can see here, it's this long symbol, but copy and paste takes care of it. And now what we basically see, I'm going to change this to a 60-minute chart so you can see it a little bit better. We can basically see that as the stock jumped and these options basically went from like $10 to $50. But if you basically thought that this stock was going to just move sideways, what would happen is that those options would basically just kind of fade away over time. And this is very often what a stock looks like after a drop like Facebook just had, or a Netflix. We usually get this chopping up and down. And instead of trying to time that or anything else, you basically can sell those at the money calls, and the stock will just, and if you're looking for a neutral trade and you're looking at those at the money calls that expire in about 3 weeks, you're going to capture the maximum time decay. And you can see that by targeting the theta and looking at extrinsic value. You'll see the same thing on both cases. The ones that are right near the money have the most extrinsic value. All right, another one. I'll go to this question now. What delta do you recommend if you want to collect premium and keep your stock? I have Apple for growth, but would like to collect premium as it grows. I have done 10 delta, not sure about the expiration date or how far out. So based on the approach that I'm showing in this webinar, if you are right now, and what I would say is that it depends on your short-term view of Apple. In terms of selling calls that expire in 3 to 4 weeks will usually give you the most time decay. All of these strategies are based upon time decay. The bearish one less so, which I'm going to get to next. But for example, when I look at something like Apple right here, I mean, if I was just to come up with an initial idea, I would just ask, where do you think Apple's going to be in a month? Say we think it's going to be roughly where it is, or maybe a little bit lower. In that case, you might want to think about applying what I would call the neutral strategy. If you think Apple's at resistance here and maybe you're going to pull back, if you were to look to sell something potentially like the 175s, that would then capture, the most, not the most time value. Well, it would basically target that neutral approach, and it would basically capture at that point the most extrinsic value that you can get, the maximum time value. And then if you're bullish on something, like for example, say Apple was at a point where it had pulled back, then you could switch to look to the 20 delta strategy. So for something which is the bullish position I just outlined. So the thought is, depending on where we are at the point of the chart, if we're at a point where we feel that Apple is going to move sideways to slightly lower, then something like the neutral strategy is something to think about. If we're at a point where, like, say it was right here and your old options expired, then you might want to be thinking about, well, Apple had this rally and this pullback. I think it's going to continue higher. And in that case, targeting something like the 20 delta, selling the ones with the 20 delta that are further out of the money, would more follow the approach that I'm showing here. And it is important, I think, to mention that 3 to 4 weeks is usually kind of the the sweet spot in terms of capturing the maximum time decay. What is the goal of the covered call? Are we looking to lower the cost of the stock or collect premium and have the stock called? Well, see, that's actually the point of this webinar in terms of the versatile covered call is that it can be used for those multiple purposes. The last approach I'm going to show you is actually one that is looking to get out of the stock, which is the bearish position, which I'm going to show next. Now, the other thing is, say, for example, if we were to go back to something like Netflix, say the stock drops and you sell the calls around 400, they're going to have, the intrinsic the premium in the beginning will have a lot of time value built in. As you come to expiration, those might be slightly in the money, and what will happen is the time value will be mostly gone, and all that's going to be left is the intrinsic value of the options. So if we look at something here like Netflix, and we look at the calls that actually, like, for example, expire tomorrow, Netflix has these these are the Friday weekly calls. And if you look at something like let's just see where it ended the day, because it ended at 4:05. So that's a tricky thing here. See, it says 4:15. But if you actually look at these, so these are very near the money, and they have about $5 of time value kind of left in them, which means that that in the last day, if the stock basically closes at 4:05, that $5 is going to disappear in a puff of smoke. So now if you look out further in time, like say, for example, you were selling two weeks out, you have $13 of extrinsic value. And you'll also notice that these have a lower theta because they have way more time. But then if you look really far out, like if you look out into something like June, you can see that the theta for the same level, the 415s, is about 15 cents. And then if you look here, the theta is 57 cents. So what you're seeing is that in terms of capturing the maximum time decay, that sweet spot is about 2 to 3 weeks out. That's really where you're going to capture the most. Now, when you look at something that is extremely short term like this, you only have 1 or 2 days for the trade to work. And the problem with that is it can get called away from you very quickly. So the idea is to look for something when you're neutral that is going to just kind of go, if it goes up or down, you essentially see it by expiration as being roughly where it is now. Stock goes up or down, none of that matters. And what essentially happens is the time value just moves out of it. The other thing, though, is that if you want to continue to hold the stock, you can buy those calls back and you still have the underlying stock as your value, and you can actually roll that position. You could, in theory, buy back the short-term calls that are about to expire and sell another contract that expires in like 3 weeks. And by doing that, it allows you to go off and capture the time value again. So the question here is really, if you are bullish on the stock, you can use a covered call for that by targeting a net delta of about 80. If you're neutral, you can basically target the move using net delta of about 50. And then the last thing is, if you're bearish, which I'm going to talk about now, is that you can target a net delta of only about 20, which now means you're selling in the money calls that are going to profit if the stock drops. This is going to give you the lowest net delta. And these are going to be short calls with the highest delta. And they're almost always going to be in the money. They capture some time value, but they can profit from the shares dropping. So let's look at a stock now that has moved up a lot. I'm trying to think of one that is actually now going to be kind of bearish. What I had thought of as an example would be something like, say I don't have this now. I'm trying to think of some of these oil stocks. They've jumped up a lot. And say you think, for example, this has been a nice run. I think the next move is going to be a pullback down in a name like a Chevron or something like that. What you would look to do is sell the calls down at the lower strike. So let's just look at something here like Chevron, for example. If we want to target a net delta of about 20, it means we want to be selling calls with a delta of about 80. And those are going to be in the money. So the stock around 134, See, these haven't moved after hours, which is nice. So if we look here at a net delta, about 80, those are gonna be around 128. Now, a position like this is interesting because it still has, 70, 80 cents of extrinsic value. So what that means is for example, if you were to sell the stock at 134.65, and then you were to sell these calls, you would bring in about $7. Now, and you consider that, 128 plus 7 is going to be 135. And you're going to have then essentially about 50 cents, or see the numbers here with the bid ask spreads are kind of off, but you're going to collect about 50 cents of just pure credit. So if the stock pulls back to 128, what's going to happen is that you're going to not lose any money on your underlying shares, and you're actually going to make a small credit from that actually happening. Now, the nice thing about a position like this is you could just sell the stock right here, or if you sell the calls, no matter where down to 128 that stock falls, you're essentially in the same position. You're going to keep that extra credit that you collected. And here's the key thing is that you're absolutely certain that you're going to actually exit the stock. If you sell something that is closer to the money and the stock pulls back, then you might end up not exiting the position. So the idea of selling a bearish covered call is to profit from the stock dropping a little bit from the time value that you collected, but at the same time, what it does is it guarantees that you exit the position. So this is something that can be useful. For example, when you see a stock having run and you don't want to necessarily sell it right away, and you can sell the calls underneath it and essentially walk away. The other thing about it is that if it really has a big sell-off, you're going to be protected down to a certain point, and then you'll still be in that position. So you might have something where, example, a stock rallies into earnings and you think, I have to take some risk off the table. You can then sell bearish covered calls underneath it. Then the stock drops and you're only going to lose a tiny bit of the upside that you had. So the way to think about that is that it essentially allows you to have a managed risk, but the key thing is it doesn't cost anything. And if you try and do something, for example, going into earnings, and you try and do like buy puts, you're going to pay money for those puts, and you have to shell out a lot of cash for premium. But if you sell calls deep in the money underneath the stock, it accomplishes the same thing, but you collect money instead of paying money. So it's a different approach. Now, of course, there is a trade-off. If you sell those calls and the stock goes higher, then you are completely excluded from those gains. So the thing about this is you want to have a position or a perspective that the stock has reached a peak. A bear call spread, I'm not going to get into that. A bear call spread is when you sell calls out of the money and then you buy higher calls as a hedge, and then you hope that the stock stays under that level. That is a different perspective. I'm not getting into vertical spreads in this webinar, but in some ways, that is a way to profit from a similar perspective. The problem, though, with something like selling a call spread is the fact that you collect a certain amount of money up front, and if the stock goes a lot higher, then you end up losing more than you collected. So people who, some people like credit spreads. There's always that risk of realizing that you're risking more capital than you're getting. All right, so you do single leg only, no spreads. This webinar is totally about covered calls. So that was just the main thing I wanted to show you. The main thing I wanted to explain in this is that a covered call can be structured all three ways. You can have a bullish perspective, a neutral perspective, and a bearish perspective. All of those can be handled with a covered call, and there's times when that might make sense. So for example, Ford is one that is a very interesting example. Ford's getting hammered after hours. And, when Ford was up here, this is the sort of time when something like a covered, selling those in the money calls can make sense. You might have this stock having run up to this level, and then you could sell the calls that are underneath, and you basically chop off the top several points of the stock. And then as it drops, you're completely protected on the drop to a level where you actually sell it. So the thing about this is that the bearish covered call is essentially when a stock has rallied up to a big level and you think that the odds now favor a move lower. By selling the calls that have about 80 delta, it's going to protect against a big chunk of that drop. And the nice thing is it's going to protect against wherever the drop is. So say Ford goes up here and you think, man, yeah, I don't think it's going to, I'm not sure how much it drops. If you just sell those calls underneath it, it can drop here. It can drop, $1, $2, $3. It doesn't matter because you've already gone and you've taken off a lot of the value that's already in the stock. And then you only have to have a position if it falls a large amount. And then you might end up still being in the position, which can be part of your goal. If it's a stock you like over the long term, like this gentleman talks about something like Apple, if you like Apple over the long term, say maybe, for example, Apple has this big move. And a lot of this was when they were doing like the car, when they had this idea that they were going to have this Apple car. And I have an approach very often when I get a news event like that, that's a little bit silly, I sell the news, and something like Apple, making money on a car. Well, it might make sense over 5 years. It's a little bit silly in the 1 to 2 month time frame. So when you get something like this big breakout that Apple had based on that idea of the car, say you think, I think this is a top for Apple for the next month. By selling like in the money calls with like 80 delta, it would allow you to basically be hedged against a pullback. The only thing is that if the stock doesn't pull back enough, you will have the position removed from you. But you still would make some money from the drop. All right. So the key thing I want to emphasize with this, a lot of people, they think of the covered call as being a neutral position, which it essentially is. But I want to emphasize that it really can have 3 different purposes. And when you look at an options chain, you have all these different options. Should I do this? Should I do that? What is the approach that, what are the calls I should sell? Something like Apple has thousands of contracts. What calls should I sell? And what I want to simply express is that by using some of these, the things that are built into OptionStation Pro, the basic things with the Greeks and the extrinsic value, by simply looking at delta and theta and extrinsic value, you can craft a bullish, bearish, or neutral trade, on positions you might have. And it's really just that simple to just think about having that delta and targeting the delta that you want. And the way to think about that is simply by you have 100 shares, you have the delta, and you then subtract it. And it's so easy to do when we have like this sort of position here, like with Apple, you can see it right off the bat. 100 shares minus 50 delta, you see exactly what it is. And it's really easy to construct it that way using the OptionStation Pro platform. Okay, if a call expires in the money, how is the settlement price determined? Can you explain about it, please? Yes. So say, for example, let's look at the contracts that expire tomorrow on Apple. So for example, if you were short something like now again, this is just crazy right now. We have this valuation where the stock did not close. I'm going to use let's use something like JP Morgan, because JP Morgan, I don't think is moving after hours. Yeah, it's basically unchanged. So let's look at a stock like JP Morgan. So say, for example, the JP Morgan call is expiring tomorrow. If you were short, say, for example, today you had 100 shares of JP Morgan and you sold the 145 calls for like 390, that would essentially be an exit price of 145 plus the premium you collect, which is shown here on the bid, which would be 148.90, which is about 50 cents above where the stock was at the time. And you can actually see that because the extrinsic value in this case is 30 cents, but it's essentially 50 cents. one of the things that I just mentioned is that when you see the extrinsic value, it takes the midpoint to determine. It doesn't look at the bid that you collect, assuming you use a market order. It doesn't take the bid that you collect. It looks at the middle here. So it's actually looking here at the value of the calls as being like 228 or something. And then it's taking that to calculate the value that you're going to see on the extrinsic value. So what would happen is on Friday at the close, your shares would just, well, probably Monday morning or whatever, your shares would simply disappear. The calls would disappear. And you, when you sold the calls, you would bring in $3.90. And then on Monday morning, you would have no shares and you would have $145 for each share. That's essentially what would happen. And if, say, for example, you say you think, man, I think JP Morgan here is going to, retest 145 or something. According to what I'm showing here is you go to like the 18, the monthlies, because that's about, 2 to 3 weeks out. And you could then look at something, you want to look for the 80 delta, which in this case would put us at like 141. And if you, by selling something like that, you'd be locking in basically $1 of like time value. So if the stock basically was to drop to like 140, you actually would be profitable as long as the stock stayed over 139, because you're bringing in $1 of time value. You're also going to take your 100 shares and turn it into 20 shares because you'd be selling 80 delta. And then if the stock were to drop, you basically would be safe all the way down to 139, which is, under where it recently, its recent low. So that would be an example of a way that you would do a bearish trade on a stock. This would be an example of one that, in my view, would be suitable, or a potential idea for a bearish covered call. If you had been long the stock and you caught the bounce, selling those in the money calls would essentially be, something that would suit what I was kind of explaining here. When you look at some of these tech stocks that have, fallen a lot, then you might want to be looking, for the potential of the upside. And in that case, you could be looking for this, giving the stock room to run, which means that you'd be looking for, a net delta closer to 80. And if you're looking for a stock like Facebook that maybe is going to stagger sideways, then you want to be charting kind of right at the money. Can you use the same Greeks info when day trading or intraday trading? All right. The problem with some of the Greeks is that delta, yes, theta, not really. And the problem with theta is what I've noticed with theta is when you get really close to expiration, you will actually find that you're going to get time decay intraday. I've never observed it closely enough. So from my perspective, day trading options is not something that I'm really prepared to address here, especially with something like covered calls. This is the idea of the covered calls. We're looking at a window of between kind of 2 and 4 weeks, depending on where we are in the expiration cycle and anything else that's happening. I wouldn't be looking at it basically on a day trading perspective. Day trading options in general is kind of a tricky thing. Now, however, the delta when you're day trading is a pretty useful one. The delta will pretty much be an accurate representation of how the stock is going to, of how the calls are going to move. Have you done a webinar on buying leap calls? No, I have not. I personally am not a believer in leap calls. And one of the reasons is, I'll tell you right now, look at the VIX. With the VIX at a relatively high level historically, options premiums are relatively high historically. In one of the problems with longer dated out of the money calls is that you're basically paying for a lot of time value, and when volatility is higher, that's going to have a higher cost to you. So from my perspective right now, this is not a terrific environment for things like leaps. All right, let me know if you have any questions. Put it in the comment. I want to go now to something else. This is something getting back to equities, but I wanted to just kind of share with you this thing I created, and it was an interesting example of how you can use easy language. And wanted to just mention that a lot of these things that we do are actually taught in the masterclass that I do with Jesus Nava. He has a webinar coming up soon. We do a masterclass sessions all throughout the month. I do several a month. He does most of them. And a lot of the things that I do, I'm focusing on kind of like how do we assess the market using the TradeStation platform. Most of what I'm looking at are things like sectors, finding individual stocks, and doing different forms of technical analysis with some of the tools that are built into the TradeStation platform. One of those is something that I called MA test days since. Now, if you went to the zip file that I shared earlier, which again is here, let me just go ahead and reshare this link. It has this thing called MA test days since. If you double click on it, it's going to bring up this dialog, and it's going to bring in this indicator that I already have. So I'm going to now go, since I've already imported it, I already have it. I'm going to go to studies, add study, MA test. Add it to my workspace. So now a few things are going to be interesting. You're going to notice here that it has two inputs. It can accept simpler exponential moving averages, and it's going to default to the 200-day moving average. So you can change these values. I'm going to keep it as it is. Now what I'm going to do is I'm going to change this to the S&P 500. For some reason this isn't working. Oh, you know why? I have to go to my data. I'm pretty sure I have it set to, yeah, I don't have enough time loaded. So I'm going to set it to say 5 years. Okay. So now I'm going to go to studies, add study, moving average one line. I'm going to set this one to the 200-day moving average. I always use green for my 200-day moving average. I'm going to color. Okay. So I wrote an article about this recently on Market Insights. That if you actually click, the article was over here. And what this study does is this looks at a moving average, and it tells you how many times since price last touched it. And if price is below it, it's going to give you a negative number. So for example, you can see here that we had 394 days that the S&P was above its 200-day moving average. Then as soon as we closed below it, or as soon as we touched it, it resets that counter, and then it's going to go to a negative number. So in this case, it starts counting 1, 2, 3. But then when it goes positive above the 200-day, you can see that this actually turns green. So we scroll it out, we zoom out, we see some interesting things. We can see that we had this run above the 200-day here, then the COVID crash. And if you look historically over the long run, this was, I believe, the 4th longest run without a test of the 200-day moving average going back to the 1960s. So I wrote an article about that at the time. And at the time I wrote the article, the S&P was somewhere up here. And by using this sort of technical analysis, this custom indicator built in the TradeStation, it allowed us to kind of say, is it time for a pullback to that moving average? And by doing some of that kind of historical study, we were able to kind of, anticipate something that did play out. So remember, if you double click on it now, you can change it, let's say to like 50-day. You can go 50. I don't have that now, but it's going to actually show, if we were to have the 50-day moving average, it's going to show, time since we tested it and everything else. You can also change it to exponential moving average, but just remember you have to spell the word exponential correctly. What again was the Insights article and the MA pullback? It's actually in the zip file that if you look at the actual slides I shared, it was back on January 19th. And it was actually based on something I did on TradingView. Early in the year, there was another article I did on TradingView that used the same analysis to kind of anticipate, this kind of pullback. But you can also look, if you go to Market Insights and you click on technical analysis, might be something some of you guys like. It's actually a series I have here. A lot of these are the things that I do for TradingView, but some of them are things that are not necessarily like this one here. So this might be something you guys find kind of interesting. One that I really thought was interesting was this article I done about energy stocks. And it's fascinating because I did this study of how energy stocks early this year had this breakout, and we compared it to what happened with technology stocks back in 2016. This was back in 2016. This was like Brexit or something here. And then basically tech stocks kind of, now at that time, tech stocks had been still, they really hadn't done very well after the dot-com bubble. They were still, they moved to a certain extent, but they didn't really break out until after 2016. It's fascinating to look. They had this long consolidation period and they broke out, and then they basically ran for the next several years. Look at energy. At the beginning of this year, the whole market's tanking. The only sector that was green was energy, and we were writing about it at the time. And then you can see the continuation to the upside. And other things in energy is just, we have been, we've written about this trend a lot. And one thing I did want to actually mention is if you look beyond energy, and we had talked about agriculture, but, there is a crazy squeeze happening right now with fertilizer. And there's only a few companies that deliver it. There's a lot of strange things happening. It doesn't get nearly the attention that it probably should. And there's a handful of stocks that have been benefiting from it. And so I wanted to just kind of mention that. So hope everyone has a great day. I'm just looking to see if I have any questions. Yeah, so again, the basic thing I just want to emphasize is that it's like a car. You have, first, second, and third gear. And the car can, first gear, it can tow a heavy weight. Second gear, it can, drive down a city street, and third gear is on the highway, something like that. It's really, the basic thing is to break it down, focus on net delta. And that is how you can basically take the covered call strategy and make it achieve three different purposes. It can be a very versatile strategy, and it can be something else for guys who trade stocks. When you have a nice stock position that has a good rip and you think this is overbought, I think it's going to pull back. Like say you had something like an Exxon Mobil and you caught a rip like this and you're like, you know what? I think it's going to pull back. You can look to sell the calls in the money, hedge against the pullback. When you have something that's like, oh man, I think maybe AMD is going to push up toward 135. By selling the call against it, you have a little bit of a hedge to the downside. And then at the same time, if you're right and it moves up to that level, you're going to be in that spot where if it moves way past your target, you're not going to get all the move. But if it moves somewhat toward your target, you're going to get the upside from the shares, but you're also going to collect the premium from those out of the money calls you sold. And when you think a stock is just going to stagger, then looking to sell the at the monies with roughly 50 delta. So that's the basic approach. If anyone has any questions, I'm going to share my email. This will be on Market Insights, drussell@tradestation.com. Also want to encourage all of you guys to consider our masterclass. Like I said, Jesus and I teach that. And if you actually dig in, like this has an easy language. I didn't even show this, but this is code that I wrote this code myself, and I'm not a developer. You can learn to do a lot of different things. All of this is explained if you actually, I explain all the lines of what happens. We're accepting the different inputs, we're defining the moving averages, and then we're detecting the crossing, and then we're basically exporting the value out. So these are all different things that are not that hard to learn, and masterclass is a great place to learn it. The last thing I'll just mention is if you do go to Market Insights, you go to Education Platform. This is where we place all these videos after the fact. They're on the YouTube channel, and then they're also archived here. So I hope everyone has a great day. See you soon, and take care. Thank you much.